Imagine this. It's a quiet Monday morning in Washington, D.C. The trading desks are calm, the bond markets humming their usual tune, until a headline flashes across every terminal. China begins selling U.S. Treasuries. In seconds, panic sweeps through global finance. The dollar trembles. Yields spike. Stock markets freeze. CNN, Bloomberg, CNBC, every anchor asks the same question. Is this it? Has China just detonated the U.S. economy from the inside? But before the world can react, another update arrives. Sales halted. Beijing denies reports. The markets breathe again. But something changes that day, because everyone suddenly realizes the truth. China can't dump its U.S. dollars. And America can't afford for them to try. They are two superpowers locked in a financial embrace so tight that breaking free would destroy them both. The question is, how did we get here? And who actually controls this $3.2 trillion trap? To understand the trap, you have to see the empire that built it. Since World War II, the U.S. dollar hasn't just been America's currency. It's been the world's bloodstream. Every barrel of oil, every container ship, every central bank transaction, all priced, traded, and settled in dollars. That demand created the largest artificial market in history. Foreign nations buying U.S. debt just to function. And none bought more than China. By 2014, Beijing had accumulated over $1.3 trillion in U.S. Treasury securities, enough to fund the entire U.S. federal government for nearly a year. It wasn't charity. It was strategy. The more China exported to the U.S., the more dollars it earned. Those dollars had to go somewhere, and the safest, most liquid parking spot on earth was America's own debt. That's the paradox. Every product you see labeled, "Made in China," helped fund the American deficit. For decades, it worked beautifully. America consumed. China produced. The dollars flowed in one direction, the goods in the other. U.S. consumers got cheap products. Chinese factories got full orders. Both governments got what they wanted, stability. But beneath the smooth surface, a dangerous symmetry formed. America's strength became debt-fueled consumption. China's strength became export dependency. Each was now hostage to the other's imbalance. That's what economists later called mutually assured financial destruction. Behind the scenes, an unspoken agreement emerged. The Federal Reserve prints. The People's Bank of China purchases. Whenever Washington needed liquidity, Beijing provided it. And when China needed its currency kept stable, America obliged. Both sides played the same game, pretending the other wasn't essential while secretly praying they'd never stop. It was an alliance. It was addiction. The dollar's dominance gave America unmatched power, sanctions, control over global transactions, and the ability to borrow endlessly. But that dominance also became a trap for everyone else. If China stopped using dollars, its exports would crash. If it dumped treasuries, its own reserves would collapse in value. Every attempt to escape the dollar only tightened the leash. It's like holding a grenade you can't throw, because you're standing on the same battlefield. Every time trade tensions flared, from Trump's tariffs to Biden's tech sanctions, pundits asked, why doesn't China just sell its U.S. debt, crash the dollar, and teach America a lesson? Because they can't. That $3.2 trillion isn't just an investment. It's collateral for the entire Chinese banking system. It backs the yuan. It anchors their currency swaps. It underwrites their credit markets. Dumping treasuries wouldn't destroy America. It would implode China first. The trap is symmetrical, and it's been engineered so precisely that neither side can move without bleeding. You might think this system can last forever, that both nations will simply keep pretending this balance is sustainable. But the cracks are already forming. In the background, quiet moves are being made. Currency swaps in yuan, trade in gold and commodities, digital ledgers to bypass the dollar entirely. Someone, somewhere, is preparing for the moment the trap finally snaps. And when it does, it won't look like a war of armies. It'll look like a liquidity crisis disguised as diplomacy. To grasp the scope, start with the number, $3.2 trillion. That's more than the GDP of France. It's larger than the combined value of Apple, Microsoft, and Amazon together in the early 2010s. It's not an investment portfolio, it's a geopolitical tether. Those dollars sit primarily in U.S. treasuries, agency debt, and dollar-denominated reserves across Chinese state banks. Every coupon payment, every maturity, Every rollover ties Beijing's balance sheet to Washington's. It's the world's largest IOU, and it defines modern globalization. China isn't alone. Japan holds over $1.1 trillion in treasuries. The UK, Switzerland, and the oil-rich Gulf states together hold another trillion. This is the web, a planetary ecosystem of countries that can't function without dollar stability. Oil trades in dollars. Shipping insurance settles in dollars. Even international loans between small African nations clear through dollar channels. If China tried to unwind its position, it wouldn't just hit the US. It would collapse the pricing mechanism for almost every global commodity overnight. The web ensures compliance by consequence. Then come the shadow players, custodial banks, and clearinghouses. Institutions like Citibank, JP Morgan, and the Bank of New York Mellon hold the operational keys to China's reserves. They process payments, manage settlements, and maintain the records that turn ownership into usability. So even if Beijing wanted to move those assets instantly, it would still need American intermediaries to execute the transaction. That's the hidden layer of control, structural dependence built not just on money, but on plumbing. Every time China exports a container full of goods, it earns dollars. To convert those into yuan, the People's Bank of China must absorb them, issuing new yuan to local exporters while adding the dollars to its reserves. This cycle keeps the yuan stable, exports competitive, and factories humming. If Beijing stopped buying dollars, the yuan would rise, Chinese goods would become more expensive, and millions of export jobs would vanish. So even though officials in Beijing talk about de-dollarization, the system punishes them the moment they actually try. Meanwhile, America's debt machine feeds off this dependency. Every treasury bond China buys allows Washington to borrow a little more, spend a little more, and delay the reckoning a little longer. The U.S. government owes over $35 trillion, and foreign buyers hold roughly a third of that. Without them, interest rates would spike and the dollar's credibility would crack. So the irony is complete. China can't dump dollars. America can't stop printing them. Each side fuels the other's illusion of control. Look at a U.S. port, Los Angeles, Long Beach, Savannah. Massive container ships unload billions in goods every week. Electronics, textiles, tools, raw materials. Behind every shipment lies a financial transaction in dollars, cleared through a U.S. bank, guaranteed by treasuries that China itself holds. It's a feedback loop so perfect it feels designed. A system where debt, trade, and currency form a self-reinforcing cycle that neither side dares interrupt. This is why even during the bitterest trade wars, the financial lifeline never fully snaps. It's not just nations that depend on this balance, it's corporations. Apple manufactures in China and repatriates profits in dollars. Boeing sells aircraft to Chinese airlines financed in dollars. Walmart's entire supply chain relies on dollar-based credit between Chinese exporters and American importers. If the dollar flow broke, it wouldn't just be economists panicking. It would be the shelves in your local store going empty. That's how deep the web runs. Still, Beijing isn't blind. Since 2010, it's been diversifying. Buying gold quietly through state banks. Signing yuan settlement agreements with over 40 countries. Building the CIPS payment system, a Chinese alternative to SWIFT. Investing in belt and road infrastructure, paid in non-dollar currencies. But even with all that, over 58% of China's reserves remain in U.S. assets. Because no other market is deep, liquid, and politically stable enough to absorb that scale of wealth. They can build the exits, but they can't yet leave. You're probably thinking, so they're stuck. What's the real danger? The danger isn't that China dumps its dollars. It's that the U.S. weaponizes them. And history shows, once America turns its currency into a tool of control, even its closest partners start looking for escape routes. That's where the next act begins. The moment the dollar's strength becomes the source of its greatest vulnerability. The first crack appeared in 2014. Russia annexed Crimea, and for the first time, the U.S. used the global dollar system as a sanction weapon. Entire banks were cut off from SWIFT. Assets frozen overnight. No missiles. No soldiers. Just code and compliance. The world saw it. So did Beijing. In that moment, China realized the dollar wasn't just a medium of exchange, it was a lever of obedience. Then came the trade war. Tariffs, blacklists, export bans. The message was clear. The U.S. could choke technology and finance simultaneously. Chinese corporations like Huawei, ZTE, and SMIC discovered that global commerce runs through an American operating system, one built on dollars, patents, and payment rails the U.S. controls. Even Chinese banks couldn't process transactions without exposure to New York clearinghouses. The world's second-largest economy was suddenly reminded. It didn't own the rules. It was playing in someone else's casino. By 2020, the trap became self-reinforcing. America's pandemic response flooded markets with liquidity. The dollar weakened temporarily, then surged as global demand for safety spiked. China's exports boomed, feeding the very system it feared. Every dollar Beijing earned found its way back into U.S. assets, treasuries, corporate bonds, dollar swaps. And every purchase strengthened the currency that could one day be turned against it. A perfect paradox. The more China tried to escape, the deeper it sank. If Beijing suddenly sold $1 trillion in treasuries, the bond market would convulse. Prices collapse, yields skyrocket, and the remaining $2 trillion they still hold would lose hundreds of billions in value. The yuan would surge, exports would crash, unemployment would explode. Capital flight would rip through the Chinese banking system. They can't dump the dollars without detonating themselves. It's like being chained to a ship you secretly want to sink, but realizing you're still standing on its deck. America's side looks safer, but it isn't. The U.S. depends on constant foreign demand for treasuries to keep rates low and deficits funded. If major holders like China even pause their purchases, Washington must step in with domestic buyers or risk fiscal panic. That's why the Federal Reserve's balance sheet keeps expanding. It has become the buyer of last resort in a world quietly stepping back from U.S. debt. The empire of paper has to keep rolling its own credit. So both sides evolve, not through confrontation, but through quiet adaptation. China shifts from dumping dollars to recycling them, buying U.S. companies through offshore entities, funding belt and road projects with dollar loans, acquiring global resources, mines, ports, energy, with greenbacks earned from exports. In effect, they're turning America's own currency into a geopolitical weapon of their own. Every dollar spent becomes influence somewhere else. Meanwhile, a silent revolution brews. China's digital yuan, the ECNY, expands quietly across Asia and Africa. It's programmable, traceable, and state-controlled. Trade settlements in ECNY bypass the SWIFT network entirely. The goal isn't to destroy the dollar overnight. It's to build a parallel lane where the U.S. can't pull the plug. But the risk is immense. If Beijing moves too fast, markets panic and the yuan collapses. If it moves too slow, it stays trapped under the dollar's gravity. That's the tightrope. Too much independence invites collapse. Too little, and they'll never escape. The dollar's greatest strength, global trust, is also its weakness. It forces the world to participate in a system they resent but can't replace. China's trap isn't just financial. It's psychological. Every economist in Beijing knows the system is unsustainable. But none can pull the trigger without detonating 40 years of progress. It's not a game of chess anymore. It's a game of chicken, with nuclear-scale consequences. Some say the dollar trap is permanent, a feature, not a flaw. But history doesn't tolerate infinite imbalance. The question isn't if the system changes, it's what breaks it. A war? A default? A digital shift? Somewhere inside those possibilities, the next economic reset is already forming. And when it hits, the trap will spring, not with an explosion, but with a whisper. You wake up in Dayton. Gas is $4.60 a gallon. Eggs cost $6 a dozen. And the news says inflation is easing. Your paycheck hasn't moved in 2 years. Every product in your kitchen, phone, kettle, sneakers, was made somewhere in China. You grumble about prices, but never think about the chain that sets them. Every carton, every circuit board, every ounce of fertilizer is ultimately priced in dollars that Beijing cannot unload. You are living inside the quiet bargain. China makes, America spends, and both pretend the loop can run forever. Half a world away, it's past midnight in Shenzhen. Li Wei scrolls through orders on her supply chain dashboard. The dollar has strengthened again. Good for export margins, bad for next month's layoffs. She doesn't own any treasuries, but the factory's line of credit depends on them. Her boss keeps one eye on Washington's debt auctions. Interest rates there decide which machines here keep running. To her, the $3.2 trillion isn't theory, it's tomorrow's paycheck. This has happened before. A century ago, Britain ruled the seas and the pound ruled trade. After World War I, nations held British debt the same way they hold U.S. treasuries today. When sterling collapsed in 1931, the empire's illusion of control shattered overnight. America studied that collapse and built safeguards, deeper markets, global institutions, the IMF, SWIFT. But the structure, others funding your empire, remains identical. The same gravity that dragged London down now surrounds Washington. During the oil shocks of the 1970s, the U.S. made a new deal. Saudi oil for U.S. protection, priced exclusively in dollars. That pact created the petrodollar, which forced the world to buy dollars before buying energy. China entered that system decades later as the world's largest importer. Every barrel it purchases still runs through dollar settlements that reinforce the same chain. When Americans fill their tanks, they feel the pain at the pump. When Chinese importers hedge fuel, they feel the pain in reserves. Two sides of the same global invoice. In 2008, the crash didn't start in Beijing, it started in American mortgages. Yet China lost billions on dollar-denominated assets it could neither sell nor defend. While Lehman burned, the People's Bank of China bought even more treasuries to keep markets stable. Think about that. The supposed rival became the silent fireman for the U.S. economy. Because if the dollar collapsed, the yuan would follow. Then came COVID. Factories shut. Supply chains froze. Stimulus flooded everything. The Federal Reserve printed trillions. China's export machine revived just in time to absorb it. The same feedback loop that began in the 1990s returned, bigger and tighter. Both nations bragged about resilience, but it was dependency in disguise. Now, in 2025, whispers in both capitals grow louder. Washington wants to friendshore. Beijing wants dual circulation. Each side talks independence, neither can afford it. Because behind every political slogan lies the same spreadsheet. Trillions of obligations priced in the other's currency. You can feel the fragility in everyday life. Prices inch higher, pensions depend on bond yields, and headlines about sanctions sound like thunder in the distance. We've been here before, empires bound by their own money. And each time, the ending wasn't explosion but transformation. The question isn't whether China will dump its dollars. It's what replaces the system when both sides finally admit it's unsustainable. Because something always follows the old order. And somewhere in that shadow, the next reserve currency is already being born. Every night, when trading screens go dark in New York, the data still hums quietly between time zones. Dollars move, bonds roll, payments clear. Somewhere in Beijing, a desk analyst reconciles the same ledgers and in turn checks in Washington. Different languages, same numbers. That's the invisible alliance that holds the modern world together. If either side flinches, the entire architecture shakes. For decades, people called it a rivalry. In truth, it's a mirror. America's strength is consumption, China's strength is production. The dollar is the bridge between them, and the bridge has become a cage. Washington can weaponize finance. Beijing can weaponize supply chains. Neither can actually win, because both are fighting themselves. It isn't a trade war. It's a balance of terrors built out of spreadsheets. Every empire ends the same way, not through conquest, but through overextension. Britain had colonies. Rome had provinces. America has debt. Its reach isn't measured in miles, but in promises. Each treasury bond is a thread, each foreign holder a weight. And when those threads tighten, even the strongest fabric starts to tear. The warning signs are visible. Rising interest costs, declining trust, growing talk of alternatives. But the collapse won't come as thunder. It will come as a quiet repricing of faith. So what replaces the dollar? Not another single currency, but a web of systems. Digital yuan, tokenized commodities, regional settlement networks, maybe even decentralized ledgers no one fully controls. The post-dollar world won't look like revolution, it will look like drift. One trade at a time, one sanction too many, until nations wake up realizing they've already moved on. That's how transitions happen, slowly, then all at once. The lesson isn't just for governments. It's for you. Every paycheck, every retirement account, Every mortgage is a miniature version of this trap. Borrowed comfort, deferred risk, mutual dependence. We all build systems we can't unwind. And when they wobble, we call it a crisis. But survival, whether national or personal, comes from the same rule. Control what you can, understand what owns you, and never confuse stability with freedom. One day, China will hold fewer dollars. One day, the US will print fewer of them. But between now and then, the illusion will hold. That paper equals power, that debt equals safety, that this time is different. History smiles at that phrase. It never is. If this story made you pause, don't let it fade when the credits roll. Look around your own balance sheet. What would collapse if someone else pulled the plug? That's the real question behind every headline about China, the dollar, or the next crisis. Because the trap isn't foreign. It's global. And it starts with us. So ask yourself, when the next reset comes, will you be holding paper promises? Or something that can stand on its own?